Okay, so let's what we have this morning. So this is the ES, and obviously all of the information I focused in at the weekend in the weekend video update on the four major US indices, and in particular the S&P 500 and the NASDAQ, to give you levels and what to look for and what would put us in the alternative diagonal count and all the rest of it. All of that is obviously applicable to the ES and the NQ. And as of this morning, we're in exactly the same place. So I either have this 1, 2, 1, A, B, C for a deep 2 here, and we've hit the 887 retrace at 28.74 on Friday in the ES, and I've got a 1764 hit here as well, and it's all about what happens next. Now, obviously, if we take out that 2865, then it is most likely that we're in the diagonal. But if we take it out without going much higher first, then I think it's just an extension of the A wave down in the diagonal, and we will still get a move back up to 29.10 to 29.16, 17 area. But on the assumption that Friday's low holds, then this is the key zone above us, 29.10 to 29.30. And if we come up into one of the fibs in that zone and then start to move down sharply, then I think we've got an A down, B back, and we're in the C of the diagonal down to around the 28.15 area. We'll get more precise targets than that. Now, while we're on this, let me just take this down a time frame here. So this is the hourly chart, and at the moment I can make a case for 5 up to here with an A, B, C back here. So I'm looking higher this morning anyway, up into that zone. What we need to see is it push on up, and if you look at the 15-minute chart, which I'll come back to, in fact, let's flip to it now. We need to see it follow the path of an impulse, which are these pink fibs and labeling here at sub-micro degree. So we get a 1, A, B, C, 2, and we're going to 1, 2, 3, 4, 5. If we stall in this area here and start to turn back down, then it indicates we're probably in the diagonal. Now, while we're looking at that, we own the, or for those of you that followed, we own the October 18th 29.50 calls on the SPX. If we see this come up to one of these fibs and come off, okay, then the sensible thing to do is to defend the premium in those positions. And the way you do it, there's two ways, okay? You can either sell the same strike date, i.e. October the 18th, 29.60 calls, okay? So you're selling a strike above. You could even sell the 29.55s, and you will keep a position in place that can still make you money, but you will claw back an amount of the premium. That's based on the idea that we still get this 3 up and we take out 29.50 before the calls expire. So we're effectively foregoing the profits, or the majority of them, in order to mitigate and minimize losses. The slightly more aggressive approach here, which I actually personally am going to look at, is if we start to come off one of those fibs, I'm going to sell the 29.30 calls. Okay, so either way, I'm protected. I'm turning it into a spread, but the 29.30 calls will bring me in a lot more premium. And if we come off at one of those fibs and we're going to get that C wave down, we're not going to get back above 29.30 before those calls expire in all probability. So it's a slightly riskier strategy to sell the lower strike, but it will recover most of the premium paid and leave us in a situation where we can relook at this. We've also got the November calls anyway, and those should still work out in either case. although I may choose to look at defending and turning those into a partial spread at some point, but I don't need to worry about those for now. So those are your two different options in terms of tweaking the position that we're in the options to make most sense given the price action that has transpired. But in terms of today, I'm looking for this to hold above 28.79, certainly above last Friday's low, and push up again, either in this 3 and get a 4, 5, and so on and so forth, or into the one of the fibs. And if we get just a C wave up to the 1.0 extension, lines up more or less with the 50%, but I think more likely here 29.17 to 18. The 138.2 at the moment lines up with the 618. If we see that and it's just a straightforward A, B, C, and we start to come off, that is when to take that defensive action in the call position. In any event, as the ES starts to move up, I would suggest we look at turning those calls into a spread anyway. It's just a question of which strike we choose to sell. Because we can make more money. We're not going to go, in all probability, beyond 29.70 or so in the next leg, even as a 3 of 3, before the calls expire. So that allows us to bring some premium in. But obviously, the higher the price of the ES/SPX when we sell that strike, the more premium we claw back in. And also, we've got elevated IV at the moment because the VIX has gone up, and therefore the volatility is gone up, so we can take advantage of that to a degree. Okay, so that's what I've got in the ES this morning, and then just coming across to the day trading chart. Sorry, the blue line needs to come down here, and you can see we've hit this 618 retrace of the move up of Friday's low. So I'm looking for either that or one step lower at the 764 to hold, and then to take out the upper blue line at 28.98 and a quarter, and push up to hopefully around the 28.16 to 18 area at a minimum, and maybe more. Okay, so that's what I've got in the SPX now. Oh, sorry, the ES.